Hello everyone and welcome back to the discussion on mock test paper number 3. Now this video, of course, you should watch only if you have solved this test paper 3, and if you haven't done it, please first download the paper and solve it. As far as the question paper is concerned, I am giving you instruction. You can just download the question paper by the link given in the description. So just click the link, follow the procedure and download the question paper, solve it, and then you may come back to this video. However, if you are watching this video after solving the test paper already, just to verify whether you have gone correct or not, you are definitely doing the rightful thing. And as earlier, I am not going to give you too much time to write down the solutions. What you can do, every time I display the content of a solution, I'll just give a pause for around 4 to 5 seconds for you to take screenshot, and then we may proceed ahead, or alternatively you may pause the video and write up the solution if any way you want to write it. So let us begin with our discussion over here, and we begin with the first question, that is titled as question 1A. Now this particular question represents question number 78 picked up from your textbook from the topic risk, return and portfolio theory. Ramesh has identified stocks of two companies A and B having good investment potential. Following data is available for these stocks. If you identify, they have given data from 2013 to 2019, that will be what, 7 years, and what they have informed is only and only about the market price per share for both the stocks A and B. Further informed in the question, you are required to calculate the risk and return by investing in stock A and B, the risk and return by investing in a portfolio of these stocks if he invests in stock A and stock B in proportion of 6:4, and lastly it is asking the better opportunity for investment. Now first of all, you may observe one thing in the question. They have not given you any information about the rate of return. Rate of return you have to determine for both the stocks, and we know one thing, that rate of return is dependent upon dividend and growth. They have given no information about dividends at all. That means only and only the change in the share price year after year, which indicates the growth rate, that will become the basis of the rate of return for each of the two stocks. And once you compute the rate of return, observe one thing, that this will be a simple individual series. Whatever they have asked further can easily be determined without any hassle. So let us see how to present the solution over here. In your solution, you first begin with the computation of returns. So computation of returns will be generally done this way: D1 plus P1 minus P0. So P1 minus P0 indicates the growth in the share price. This is the component of return which indicates growth, and this is the component of return which indicates the dividend yield. So this will be divided by the base year's price. Because here there is no dividend information, we will have to simply compute the growth rate by taking D1 as 0, and P1 minus P0 divided by P0 for each year will become the rate of return for that particular year, and when multiplied by 100, the result will be in percentage. So you may write up that formula and define the variables. You know it very well, and once you define these variables, you may also write a note. As there is no information about dividends, the rate of return will be representing only growth in share prices. So please write up this initial part of the solution, and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and start calculating the rate of return for the two stocks A and B. Now here you need to take a small precaution. You have been given data from the year 2013 to 2019. That will be data for 7 years. Now we have the data in the form of the share prices. So as I told you, we don't have information about dividend. So the only thing what you can do is compare the share prices and determine the growth rate, and such growth rate will represent the rate of return. However, if you compare year 2013 and year 2014, we will consider 2013 as the base year. That means 19.60 will be considered as P0 and 18.75 will be considered as P1, and that rate of return will be actually the rate of return for 2014. To compute the rate of return for 2013, you need the price that would have prevailed at end of 2012, which is not informed. That means even though they have given data in terms of share price for past 7 years, you will actually be able to compute the rate of return only from 2014 to 2019. You will not be in a position to compute the rate of return for 2013 because the previous year's share price is not known. So what you may do is simply put a dash over here, and once you do that, computing the rate of return for 2014 will be simply taking 18.75 minus 19.60 divided by 19.60, that is P1 minus P0 divided by P0. Because in the year 2014 the price has reduced, the growth rate will be negative, which will represent a negative rate of return, that is negative 4.34%. Thereafter the prices have increased, that means the rate of return thereafter would be a positive rate of return year on year basis. And what you can check, once you get these rate of returns, of course in 2019 again you have a decline in the share price, that would give you a negative rate of return, and we could gather the rate of return only for 6 years. Now please understand, this is a simple individual series where data is available for each individual year in the form of rate of return, which we have just obtained right now. We should be consciously aware of one thing, that this is the data for 7 years, but we could obtain the rate of return only for 6 years. So all the computations will be made by considering these 6 years only. So henceforth the number of years that we will consider will be only 6 years and not 7 years. So the aggregate of returns for stock A, what we are taking over here as 83.95, will be the aggregate of 6 years returns. And now similarly we will have to compute the rate of return for stock B as well, where the first year, that is 2013, we cannot compute the rate of return, so simply put a dash and then compute the rate of return for each of the years ahead, and wherever the prices have declined, the rate of return will be negative. So both these aggregates are actually aggregate of 6 years. After this we can easily determine the simple arithmetic mean for returns of stock A and stock B, and then we can make the calculations further. But before we proceed ahead, quickly write up these calculations. Alright friends, once you have completed writing this much, let us move ahead and make the remaining calculations. This time when we prepare this table for computing the deviation of returns for stock A and stock B, the squared value of deviations and the product of deviations for computing covariance between the returns of stock A and stock B, mind it, we will be taking only 6 years, that will be from 2014 to 2019. So we will just copy the rate of returns for stock A and B, what we have obtained in the previous slide, along with their respective totals, and we will just do one additional calculation below the table, that will be the average returns for stock A and stock B. Because it is simple individual series, it will be a simple arithmetic mean that we will compute for stock A and stock B. So it comes to 13.99% for stock A as average return and 16.19% as for stock B. Now I am sure you are ready with your calculations. Let us check whether you got the deviation values correct, and if deviation values are correct, your calculation of squared value of deviations would also go correct. That will be with respect to stock A as well as with respect to stock B. And once you obtain the squared value of deviations for both the stocks, you will take their totals and you will also take the product of DA into DB for the purpose of computing covariance, and the total of DA into DB and that comes to a negative value. That means when you try to compute the covariance between stock A and stock B returns, it will be a negative covariance, and negative covariance indicates a negative correlation as well. I give you a couple of minutes to check your calculations and then proceed ahead. Alright friends, once you have completed all these calculations, let us move ahead and continue the calculations further. The variance of returns for stock A and stock B, because it is simple individual series, the variance of return will be summation of dA squared divided by n for stock A, and that comes to 1037.7814, and similarly for stock B, that will be summation of dB squared divided by n, and that comes to 597.0291. Now both the places, don't forget that we are taking the number of years as 6 years. Standard deviation of returns will be the square root of the variances, and the standard deviation of returns for stock A comes to 32.2146%, and for stock B the standard deviation comes to 24.4342%. So please write up these calculations and then I take you ahead. Alright friends, once we have computed the standard deviation of both the stocks, so we have computed actually the returns as well as the risk for both the individual stocks. Now let us see what would happen if we construct a portfolio of stock A and B. For this purpose we will have to compute the covariance of returns between stock A and B, and we already knew one thing, that summation of dA into dB was negative, and therefore the covariance between A and B will also be negative. Once you compute the covariance of returns between stock A and B, now you can compute the portfolio returns as well as the portfolio risk. Portfolio returns, that is RP, will be the weighted average of returns of stock A and stock B. So that will be applying 60% and 40% as weights for stock A and B respectively, and that comes to 14.87%. So please write up this whole thing and then I take you ahead. Alright friends, once we have completed writing this whole thing, let us move ahead and compute further. That will be the portfolio standard deviation, for which first you have to work out the portfolio variance. So portfolio variance, I don't have to explain you how to make the calculations, you know it very well. Substitute each of the values properly and make sure that you don't end up making any calculation errors over here. And once you compute the portfolio variance, it comes to 461.4162, and the standard deviation of portfolio will be the square root of the portfolio variance, and that would come to 21.4806%. So please write up these calculations and then we shall move ahead and write up the conclusion required in the solution. Alright friends, once you have completed writing all these calculations, let us move ahead and write up the conclusion over here. On the basis of returns, stock B is preferable, and on the basis of risk, portfolio investment is preferable over the individual stocks. So please write up this single line conclusion and that will be end of this solution. Alright friends, once you have completed writing this whole conclusion, let us move ahead and take up the next question, that is question number 1B. This is picked up from the forex topic from your textbook. It is question number 84. So let us deal with this. X Limited purchased an asset for $1 lakh on 1/10/2021. The exchange rate on that date is rupees 74.00 to rupees 74.60 for each dollar. The amount was to be settled after 3 months, that is on 31/12/2021. On 1/10/2021, the forward rate available was $1 equals to rupees 74.30 to rupees 75.00 for 3 months, and X Limited entered into this forward exchange contract. On 1/12/2021, X Limited is aware of the fact that it will be unable to make the payment on 31/12/2021 and requires an extension for 2 months, and expected date of settlement shall be 28/2/2022. X Limited could convince the supplier to accept the delay. Therefore, the company plans for rollover of original contract on 1/12/2021, when the forward rate available for 1 month is $1 equals to rupees 74.70 to rupees 75.50, and for 3 months it is $1 equals to rupees 75.20 to rupees 75.80. Determine the following: action to be taken on 1/12/2021, cancellation charges payable by X Limited, new forward rate applicable for extension, and overall impact of rollover on X Limited's profit. So what is needed over here? This question is exactly similar to the earlier question, that is question number 83, but here there is one major difference. So the company again is an importer. It has made an import of $1 lakh on 1st October 2021 and requires 3 months for settling the payment that will be due on 31/12/2021. And for its hedging, the company has entered into forward exchange contract. So the applicable forward ask rate will be rupees 75, and therefore the forward contract obligation will be 1 lakh $US into rupees 75 per dollar, that is rupees 75 lakhs. The maturity date of this contract was 31/12/2021. However, the company has already got aware of the fact that it will not be able to make the payment at an early date. Do you notice? Contract maturity date is 31/12/2021, and on 1/12/2021 X Limited is aware that it will not be able to honor the contract, and the action is not taken on 31/12 this time. The action is taken on 1/12/2021. So if you have not reached the maturity to cancel the original forward contract to buy $, definitely you have to take a reverse position, that is sell 1 lakh $, but you cannot sell at spot rate because the contract is not matured. The remaining maturity of contract is 30 days. So over here what will be needed? The company will have to roll over its contract on 1/12/2021 by cancelling the original contract and then entering into the new contract. Therefore, from 1/12/21 to 31/12/21, it's a gap of, you can say, 30 days or 1 month. So you cannot have a spot sell over here. You will have to sell forward 1 month for cancelling the original forward contract, and therefore the forward rate applicable for 1 month will be picked for that purpose. So 1 month forward rate on 1st December 21 is basically 74.70 to 75.50 per dollar, and we will have to pick 1 month forward bid rate for cancellation of original forward contract. And on the same date, that is on 1/12/2021, when you are taking a new forward cover which will mature on 28th February 2022, from 1st December 21 to 28th February 22, the gap is basically 3 months. So you have to enter into a new contract for 3 months, and because you want to buy $1 lakh, you will have to pick the forward ask rate of 75.80 per dollar. So action to be taken on 1/12/2021, it will be sell 1 month forward and buy 3 month forward. Then cancellation charges payable by X Limited. Very easily you can calculate. X Limited originally committed to buy dollars at rupees 75, and for cancellation it has to sell dollars at 74.70. The difference between the two will be payable by X Limited to the bank, and that difference is 75 minus 74.70, that will be 0.30 per dollar, and multiplied to $1 lakh, it will be rupees 30,000 that the company has to pay towards cancellation. The new forward rate applicable for extension will be the 3-month forward ask rate, that is 75.80 per dollar. And the last line what they are asking, overall impact of rollover on X Limited's profit, 75.80. When you consider this as your new contracted forward rate, it will create your obligation at 1 lakh multiplied by 75.80, that will be rupees 75 lakh 80,000, whereas your original obligation was at the rate of 75. So your obligation is increasing from rupees 75 lakhs to 75 lakh 80,000. So increase in your obligation is by 80,000. That 80,000 will cause a reduction in your profit, and even the cancellation charge of 30,000 will cause a reduction in your profit. So overall impact on X Limited's profit will be 30,000 plus 80,000, that will be 1 lakh 10,000. Let us look into how to present your answer over here. Original liability as per forward exchange contract taken on 1/10/2021, it will be $1 lakh into rupees 75 per dollar, that is rupees 75 lakhs. On 1/12/2021, the company is aware that it will not be able to honor its forward contract obligation on 31/12/2021. Therefore, for cancellation of original forward contract, X Limited has to take a reverse position by entering into a forward exchange contract for remaining maturity period of 1 month of the original forward contract, that is sell forward 1 month. In such case, the contracted forward rate shall be considered as the cancellation rate, and such cancellation rate will be $1 equals to rupees 74.70. Please write up this part of the answer and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further in the solution. In order to take new forward cover for buying $1 lakh on 28/2/2022, the company has to enter into another forward contract for 3 months. The contracted forward rate will be rupees 75.80 per dollar. Therefore, on 1/12/2021, the company has 3 unsettled forward exchange contracts as mentioned below. Now the first contract is the original contract. Date of entry is 1/10/2021. Date of settlement is 31/12/2021, and this contract is to buy a foreign currency amount of $1 lakh, and the contracted rate is rupees 75 per dollar. On 1/12/2021, the company entered into a new forward contract to sell 1 lakh US dollar, and this contract was entered into for 1 month. The moment you enter into this contract for 1 month, its settlement date is 31/12/2021. Look at what is happening. 31/12/2021 and 31/12/2021, both of these contracts will have same date of settlement, and they will actually cross cancel with each other because the contract could be generally taken from the same bank. So you are one side buying and another side you are selling the same quantity, and therefore only the differential of this rate will be payable to the bank as cancellation charges. So buying at 75 and selling at 74.70, that differential of 0.30 will be cancellation charge per dollar multiplied by quantity of $1 lakh. It will be 30,000 as cancellation charges. Now the new forward contract is the third contract that is emerging in the case. The date of entry is same 1/12/2021, but date of settlement is 28 February 2022. This contract is to buy $1 lakh at the rate of rupees 75.80 per dollar. Before I give you the remaining part of the answer, first write up this much quickly. Alright friends, once you have finished writing this much, let us move ahead and continue writing further in your solution. On 31/12/2021, the cross settlement of 2 forward contracts will result into a loss as follows. Buy $1 lakh, that is the original contract, at rupees 75 per dollar, and you sell forward 1 month at 74.70. Both of these contracts will square off each other because they have a common settlement date, and therefore the cancellation is resulting into a loss of rupees 0.30 per dollar. In other words, the cancellation charge is rupees 0.30 per dollar. So the total cancellation charge payable by X Limited will be $1 lakh into rupees 0.30 per dollar, and that works out to rupees 30,000. The new forward rate applicable for extension will be the ask rate for 3 months forward contract on 1/12/2021. The contracted forward rate will be rupees 75.80 per dollar. So please write this as well, and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing further in your solution. Overall impact of rollover on X Limited's profit. So we find that your cancellation charges were 30,000, and what has happened because of the new forward contract, your obligation has increased from 75 lakhs to 75 lakh 80,000, and overall impact of rollover on X Limited's profit, that the profit gets reduced by rupees 1 lakh 10,000. So please write this as well, and then I take you ahead. Alright friends, once you have finished writing these calculations of overall impact of rollover on X Limited's profit, let us move ahead and now write up a note. On 1/12/2021, the company has formulated a strategy of sell forward 1 month and buy forward 3 months. This results into a rollover of the contract before maturity. That is, the company can extend the date of honoring the contract by 2 months by incurring a cost of rupees 1 lakh 10,000. This basically is the overall impact of rollover on X Limited's profit. However, if the company would have simply decided to sell forward 1 month, then it will result into cancellation and not rollover. The cost of cancellation will be only rupees 30,000, but the company would be exposed to foreign exchange risk for 3 months period, that is from 1/12/2021 to 28/2/2022. So once you finish writing this note, we shall move ahead. So quickly take note of this entire important note. Alright friends, I am sure you have completed writing this entire solution. Let us move ahead and take up the next question, that will be question 1C. This is again picked up from the topic Forex, and from your textbook it is question number 75. So let us deal with this. It says an exporter is a UK based company, invoice amount is $350,000 and credit period is 3 months. Exchange rates in London are spot rate they have given in terms of dollar per pound, and 3-month forward rate also they have given in terms of dollar per pound. Rates of interest in money market have been given for deposits and loan for dollar as well as pound. Compute and show how a money market hedge can be put in place. Compare and contrast the outcome with a forward contract. So again what we find that this is a case of exporter, correct? But here we find that the exporter is a UK based company. The exporter being UK based company will find that $350,000 is receivable, and this is a receivable in foreign currency. So the foreign currency will be US dollar and the local currency will be UK pound or GBP. So finally what we are going to do, just like earlier case, the way we have solved the previous question, what we have done, this is a case of exporter. There is already a dollar denominated asset or a foreign currency denominated receivable, and we would create a hedge by creating a dollar denominated liability. So to do that, same steps, you will borrow in US dollar, correct, and convert that into GBP, that is your local currency, that is convert that dollar value into pound and invest that in UK, so that the maturity value finally is in your local currency, that will be GBP. So friends, this is exactly same approach what we have followed in the earlier question. So let us see how to present the solution. Let us first make the calculation of the forward contract. amount receivable is $3,50,000, that will be foreign currency, and the exchange rate is 1.6140. The reason why we are dividing and not multiplying, you have learned this very well in forex, because the quote was not given for dollar, quote was given for pounds. And finally, the converted pound value which we find as receivable in our own currency is pound 2,16,852.54. Now this is just one line calculation. The bigger calculation will be with respect to money market hedge. So under money market hedge, amount to be borrowed in dollar for creating a dollar liability having a maturity value of $3,50,000 with interest after 3 months, and interest rate applicable in US for borrowing is 9% per annum. So it will be again 2.25% for 3 months. So because the maturity value should be 3,50,000, the amount to be borrowed today will be the present value of $3,50,000, which will be 3,50,000 into 100 by 102.25, and finally that present value comes to $3,42,298.29. So friends, we would take the process ahead, but first what you do is write down all these calculations quickly. Alright friends, you would have finished writing this much. Let us move ahead and take up the calculations further. So that amount what you have just obtained, that amount will be converted into pound, that is sell spot at $1.5905 per pound, and that will give you the value in hand as pound 2,15,214.27. So simple thing, whatever dollar amount you have borrowed, dollar is not your currency, you will sell spot that dollar and obtain the initial value in hand in terms of pounds, and that amount you are going to invest in UK. In other words, you are going to make investments in pound itself, and the deposit rate is 5% per annum, and that will be applicable for 3 months. So the maturity value finally what you will get after adding interest will be pound 2,17,904.45, and what we find that this receipt is more than the receipt under forward contract. So we may conclude, since the amount receivable in money market hedge is higher, the company should go for money market hedge. So friends, please note down all these calculations and conclusion, and that will be end of the solution. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question, that is question number 2A. Now this is picked up from the topic derivatives, and from your textbook it is question number 18. So let us deal with this. Beta of X Limited with Nifty is 1.25 times. Mr. A holds 20,000 shares in X Limited, which are currently priced at rupees 120 per share. Mr. A expects the price of these shares to decline over coming 3 months and decides to use 3-month Nifty futures to hedge the risk. 3-month Nifty futures is currently priced at rupees 10,000 per Nifty. Mr. A wants to know the outcome of holding 3 months Nifty futures under the following scenarios. Number 1, if after 3 months the price of X Limited's share falls to rupees 108 per share, if after 3 months the price of X Limited's share rises to rupees 126 per share, if after 3 months the contract of Nifty futures is priced at rupees 9,280 per Nifty for settlement. The question conveys some more information ahead, that is, after understanding the outcome of all possible situations as mentioned above, Mr. A enters into Nifty futures contract for hedging the stock risk for the period of 3 months. After 3 months, the actual price of X Limited's share was rupees 1,100, and contract of Nifty futures got settled at rupees 9356 per Nifty. Determine the net position on expiry of 3 months. So friends, something different in this question what we observe is that we have two different situations. One is at the planning stage and one is the actual outcome. So at the planning stage we are going to deal with three different scenarios, and then we will observe the actual outcome of this actual scenario given to us. That means this is the actual information on expiry, where we have to look into how would you determine the net position of the investor. And so let us proceed with the solution now. The earlier part will be same, only the later part in this solution is little different. So how would you present your solution? The same way. First step, value of stock portfolio, it will be 20,000 shares at rupees 120 each, which will give you rupees 24 lakhs as the value of stock portfolio. Step 2 is always to determine beta. The beta is already given in the question as 1.25 times. So the desired value of Nifty futures portfolio, we have just discussed a minute back that if you want a perfect hedge, the hedge ratio must match with beta, and therefore we have planned the hedge ratio as 1.25, which is equal to beta. So what happens? 30 lakhs is the desired value of Nifty futures portfolio. Now number of Nifty futures that you should contract over 3 months will be desired value of Nifty futures portfolio divided by Nifty futures price, and that gives you 300 Nifties. Please take note of this much and then we move ahead. Alright friends, you would have finished writing this whole thing. Now in this case where we need 300 index to be contracted, fortunately there is no limitation. So we can definitely plan a perfect hedge with respect to 300 Nifties. So what we do ahead is, next step, situation 1, share price falls to 108 per share. So currently the price of the share is rupees 120, where the value of the overall portfolio today is 24 lakhs, and the expected value after 3 months will be 20,000 shares multiplied by 108, which will be 21 lakh 60,000. The resulting loss will be rupees 2 lakh 40,000. Note down this as well and then we move ahead. Alright friends, after writing this, we will look into what happens to the Nifty futures price after 3 months. So, expected settlement price of Nifty futures contract. So, first of all, the fall in the share price. Presently, the share price was 120, which is expected to fall to 108. So, the expected decline is 10%. Fall in the share price will always be equal to fall in Nifty multiplied by beta, that is into 1.25. So, we can find the fall in Nifty, that is 10% divided by 1.25, and that is 8%. So, the expected settlement price of Nifty futures will be 10,000, the current price minus 8%, and that gives you 9,200. This is the expected price on settlement. Note down this as well and then we move ahead. Alright friends, you would have finished writing this. Let us see the impact of this expected settlement price on the gain or loss that arises on Nifty futures contract as expected after 3 months. So, the contract price of Nifty futures with short position is 10,000. That is what we have entered into today, and the expected price on settlement is 9,200. As simple as you have agreed to sell at 10,000 and on settlement the price is 9,200. Obviously, you have made a gain of rupees 800 per Nifty, and the number of Nifty futures contracted is 300, and therefore the resulting gain will be rupees 2,40,000. The net position will be the loss in stock portfolio and the gain in Nifty futures, that is knocking off each other, and the final resulting expected position is nil, and this is why, because we have created a perfect hedge. Note down this and then we move ahead. Alright friends, you would have finished writing this much. Let us move ahead and deal with situation 2. In situation 2, the share price is expected to rise to 126 per share. So what happens to stock portfolio where you have a long position? The value today is 24 lakhs and value after 3 months will be 25 lakh 20,000, and therefore this time we are expecting a gain of 1 lakh 20,000 in the stock portfolio itself. Note down this and then we move ahead. Alright, let us move ahead and look into what happens to Nifty futures contract. So expected settlement price of Nifty futures contract. Now you see, increase in the share price this time is by 5%, and increase in share price will be always equal to increase in Nifty multiplied by beta. Through this we can determine the increase in Nifty futures price, and that will be 4%. This time, my friends, you have taken a short position in Nifty futures and the price of Nifty futures has increased by 4%. Obviously you are going to incur a loss because you have agreed to sell at 10,000 and the settlement price is 10,400. So how much will be that resulting loss, we will observe, but first take note of this much. Alright friends, let us move ahead and look into the resulting loss in Nifty futures. So we have taken Nifty futures contract with a short position where the contract price is 10,000. That means we have agreed to sell at 10,000 and the expected price on the settlement is 10,400. So the expected loss per Nifty future is rupees 400 and the number of Nifty futures that we have contracted 300. So finally the resulting loss will be 1,20,000 and the net position remains nil because we have created a perfect hedge. So note down this as well and then we move ahead. Alright friends, let us move ahead with situation number 3. In situation number 3, one thing differently given is, it is the expected Nifty futures price after 3 months given to you as 9280. This is the expected price at which the investor believes that the Nifty futures will get settled, and therefore first we will this time determine the position in Nifty futures contract. So the settlement price is 9280 and the contract price with short position is 10,000. So again, definitely the investor is going to make gain through Nifty futures of rupees 720 per Nifty, and number of Nifty futures that you have contracted 300, and the total resulting gain is 2,16,000 rupees. Note down this much and then we move ahead. Alright friends, let us move ahead and look into impact of this in the stock price. So first of all, the fall in Nifty is computed as 7.2%, that is 10,000 of price today is expected to become 9280. Obviously the resulting fall by percentage will be 7.2%, and fall in stock price will be fall in Nifty multiplied by beta. So fall in stock price this time will be 9%. So what will happen? The expected stock price will be 9% lower than 120. That will be 109.2. Please note down this as well and then we move ahead. Let us now look into the impact of this reduced stock price, the expected price of the stock, which is 109.2. What will be its impact on the stock portfolio? So in the stock portfolio, we have long position. So value today is 24 lakhs and expected value after 3 months will be at the rate of 109.2 per share. 21,84,000 in total, and therefore the resulting loss is 2,16,000. The net position is again nil because we have planned a perfect hedge. Note down this as well, and then we move ahead. Alright friends, you would have finished writing this. So these were the expected outcomes of the three scenarios that the investor has predicted. But actually what will happen is the fact given to you on expiry of 3 months, and that impact let us try to understand, and that will be the last part of the solution. So what happens after 3 months? Actual outcome on expiry of 3 months. Stock portfolio where you have long position, value today is 24 lakhs and value after 3 months is not expected, but the actual value is 22 lakhs, and so the actual resulting loss in stock portfolio is 2 lakhs. Note down this first, and then I show you the outcome of Nifty futures. Alright friends, so let us see what happened to the Nifty futures contract. That is the actual outcome on expiry on settlement of Nifty futures contract. So the price of Nifty futures that we have contracted with a short position is 10,000, and the actual price on settlement is 9356. So we still have a gain. Resulting gain is 644 per Nifty, and number of Nifties were 300. So the actual gain over here is 1,93,200. So what happens as a net position? We have suffered with a loss of 2 lakhs in the stock portfolio, and we have made a gain of 1,93,200 in Nifty futures. The overall position, the net position, is a loss of 6,800. Though we have planned a perfect hedge, but it is not necessary that actual outcome will exactly be zero. Understand, three scenarios what we have observed earlier were all expected by the investor, and what we find now is the actual scenario on expiry of 3 months. So note down this, and it will be end of the solution. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question. That will be question number 2b, and this question is again picked up from derivatives part 2, and that will be question number 25 as per your textbook. Let us deal with this question. Sumana wanted to buy shares of EIL which has a range of rupees 411 to rupees 592 4 months later. The very first line gives you an indication that there are two probable prices in future. The future that we are looking over here is 4 months later. The price of the share could be either 411 or 592. Now one thing is clear, these two are given as LPP, that is lower probable price, and HPP, higher probable price. The present market price per share is 421, so this is S0. Her broker informs that the price of this share can store up to rupees 522 within 4 months or so that she should buy a 4-month call of EIL. In order to be prudent in buying a call, the share price should be more than or at least rupees 522, the assurance of which could not be given by her broker. Though she understands the uncertainty of the market, she wants to know the probability of attaining the share price rupees 592, so that buying a 4-month call of EIL at execution price of 522 is justified. Advise her. Take risk-free interest to be 10.8% per annum, and in the question itself they have given that e raised to 0.036 is 1.037. So with this information we are getting a clarity that the question itself is demanding continuous compounding. So this is an implied information, though they never inform that the continuously compounded risk-free rate is this, but with this we get a hint clearly that this rate has to be a continuously compounded risk-free interest rate. So how to solve this question? In the solution, first you should write that same note that I gave you some time back and let that note be part of the solution. So in your solution, you should write under binomial model, probability of rise in price is I minus D upon U minus D. Define all the three variables, that is I, U and D, and I have no need to explain you these variables, you know it very well. In case of continuous compounding, you are going to replace this capital I with e raised to RT, that you should mention, and once you write this note, I will take you ahead and help you solving this question. Alright friends, once you have completed writing this much, let us move ahead and continue writing the solution further. So I am just mentioning again, probability of rise in price will be e raised to RT minus D divided by U minus D. Now let us define the variables over here in the context of the given information. E raised to RT will be e raised to 0.108, that is 10.8% will be written as 0.108 in absolute form. T stands for time, time is 4 months, but time has to be mentioned in years, so it will be 4 by 12. Pick your calculator and check 0.108 into 4 by 12 would give you 0.036, and value of e raised to 0.036 is already given in the question as 1.037. Further, U will be HPP divided by S0, that will be 592 divided by 421, that gives you 1.4062. D will be lower probable price divided by S0, that is 411 divided by 421, and that gives you 0.9762. So probability of rise in price will be basically this factor. So e raised to RT is 1.037. So e raised to RT minus D divided by U minus D, you can apply the calculation and you will find the probability as 0.1414. So what we can conclude over here, the probability of rise in price is actually very low. So taking a call option with such a low probability could be very risky, and that is what we will advise. But first you write up this calculation and then we write up that conclusion as well. Alright friends, once you have completed writing this much, let us move ahead and write up that conclusion. So you may write Sumana has very low probability of rise in share price, that is just 14.14%. You can write even 0.1414, not a problem. So 14.14%. Buying a call option with such low probability of rise in price will be a risky decision. That's all. So please write up this whole thing and it will be end of the solution. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question, that is question 2C. And this is again picked up from the topic derivatives part 2, and that will be question number 61 from your textbook. Let us deal with this. A call and put exist on the same stock, each of which is exercisable at rupees 60. They now trade for market price for stock or stock index is given as 55, market price of call and market price of put. Basically the market price of call and put indicates the premium of the call and put option, correct? So these are not the strike prices, right? These are the premium for respectively call and put option. The strike price is 60 and current market price is 55. Calculate the expiration date, cash flow, investment value and net profit from 4 of these alternatives, that is buy one call, write one call, buy one put and write one put. For expiration date, stock prices of 50, 55, 60, 65 and 70. So friends, there are in total 4 scenarios. Buy one call means holding one call option, write one call means writing a call option, then holding a put option and writing a put option. 4 different scenarios, and in each scenario we have to show impact of these 5 different market prices on the profitability of the investor. So let us see how to present the solution. We start with the first thing,
Buy one call means holding one call. So you just write up the headings as market price, action taken, gross payoff, premium expenses and net payoff. Market price ranges are given to you as 50, 55, 60, 65 and 70. Understand one thing very well, that the case what you are dealing with is buying a call option. So you are holding a call option, and you know one thing, that call options are exercised only when market price is greater than exercise price. In the given question, the exercise price is 60. So market price is less than 60, less than 60, equal to 60. That means in first three cases, the call option will not be exercised. It will be exercised only in the last two cases, because the condition for exercising call option is market price should be greater than exercise price. So in the first three situations, you will let the call option go lapse, and in the last two situations, you would exercise the call option. Gross payoff for a call option, when it gets lapsed, it is 0 simply. When it is exercised, it is MP minus EP. So 65 minus 60, 5, then 70 minus 60, that is 10. Premium expenses for any case would be just 999, and net payoff is gross payoff minus premium expenses. So first three case it will be minus 9 each, and thereafter 5 minus 9 would give you minus 4, and 10 minus 9 would give you just 1 rupee of net profit. So write up all these calculations and then we shall move ahead. Alright friends, after finishing the first scenario, when you go to the second scenario, it is writing one call option. So you would make again a similar table: market price, action, gross payoff, premium income and net payoff. So one big difference between the first and second scenario, that time you wrote premium expense, now it is premium income, but the type of option remains a call option. Okay, don't forget. Just the only difference is, instead of holding a call option, now you are writing a call option. So market price, same 5 different prices. Action taken won't change because this is still a call option. Gross payoff for the first 3 would be 0, 0, 0 because it is getting lapsed. And the time when you talk about exercising a call option, mind it that this time you are not holding a call option. So payoff will not come to your pocket, it will go out of your pocket. That means the gross payoff will be negative cash flow. So it will be EP minus MP, and that will be 60 minus 65 as minus 5 and 60 minus 70 as minus 10. Premium income in all cases will be 9, and gross payoff plus premium income will give you net payoff. So it will be positive 999, then positive 4 and minus 1 at the last case. So note down all these calculations also, and then we move ahead. Alright friends, after writing up this part, let us move to the third requirement when you are holding a put option. Again a similar table, similar headings, but this time it is a case of put option and you are an option holder. So premium comes over here as an expense. Same 5 different market prices. Now it's a case of put option with a strike price of 60, correct? Now compare. Being a case of put option, it is exercisable when market price is less than exercise price. Exercise price is 60 and market price 50. Perfect case for exercising a put option. So you would exercise. Even when the market price is 55, you would exercise. In both these cases, the put option is in the money. When the market price is 60, it is matching with the exercise price, and the put option is at the money and it will not be exercised. You will let it lapse. And likewise, in the next 2 scenarios, the put option goes out of the money and you would let it lapse. When you are exercising a put option, its gross payoff or intrinsic value is always EP minus MP, that is strike price minus market price. So 60 minus 50, 10, and 60 minus 55 as 5, and when it is lapsed, the payoff would be 0, 0, 0. Premium expense for put option in all cases would be 1, and net payoff is always gross payoff minus premium expenses. So it will be 9, 4, minus 1, minus 1 and minus 1. So note down these calculations and then we move ahead. Alright friends, you would have finished writing these calculations. Let us move to the last scenario where you are writing a put option. So just again the case of put option, only difference is now you are a writer. So first change would be the premium column will not be indicated as premium expense. In this case it is premium income. Same 5 market prices. Action taken would also be same as you have done when you were holding put option, because still the logic remains same. Put option is exercised whenever market price is less than exercise price. So first and second case, the action will be exercise the put option, and in the next 3 you will let it lapse. Gross payoff will be, because you are a writer, don't forget, gross payoff will be MP minus EP. So 50 minus 60 as minus 10 and 55 minus 60 as minus 5. In other 3 cases it will lapse, so 0, 0, 0. Premium income was just 1 rupee in all the cases, and your gross payoff plus premium income will give you the net payoff minus 9, minus 4 and then positive 1, 1 and 1. So write up these calculations also, and that will be end of the solution.
Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question, that is question 3A. Let us deal with this question, which is question number 15 from the topic mergers and acquisitions.
Yes Limited wants to acquire No Limited, and the cash flows of Yes Limited and the merged entity are given below. They have given you figures in rupees lakhs. Now the cash flows for 5 years have been given for Yes Limited and the merged entity. Further it says earnings would have witnessed 5% constant growth rate without merger and 6% with merger on account of economies of operations after 5 years in each case. The cost of capital is 15%. The number of shares outstanding in both the companies before the merger is the same, and the companies agree to an exchange ratio of 0.5 shares of Yes Limited for each share of No Limited. Now what you have been given, PV factors at 15% for year 1 to 5. The question itself informs you the PV factors, and you are required to compute the value of Yes Limited before and after merger, value of acquisition and gain to shareholders of Yes Limited. So friends, before we begin with the solution, let us first discuss out something important given in this question. Now first of all, the cash flows have been reported for the coming 5 years on an estimated basis. Now what happens after 5 years is not given. So after 5 years, obviously you are going to find out a terminal value. Now there are 2 possibilities. Possibility number 1, that your business continues even after these 5 years, or your business terminates. If your business continues, that means after 5 years the value of the business will depend upon the future cash flows, and for that reason the question has informed you growth rate. There is a different growth rate that will apply if you do not merge with No Limited, and there is a different growth rate that you apply if the merger takes place. So in either case you will find the terminal value at end of 5th year. So the cash flows given over 5 years are the reported cash flows or the estimated cash flows of the coming 5 years, and what will happen after 5th year, the terminal value should be determined. For this purpose you may simply use the cash flow growth model, where you will take in the numerator D1 and divided by KE minus G, that approach. So P0 equals to D1 upon KE minus G. The dividend growth model or the cash flow growth model can be applied, and this will depend upon the expected cash flows for the 6th year. And to arrive at the cash flows of 6th year, the base will be the cash flows of 5th year, and between 5th year's cash flow and 6th year's cash flow, growth rate will be involved. That is one thing. The most important point in this question is the last part, where the question has asked you to determine the gain or loss to the shareholders of acquirer company, that is Yes Limited. So friends, how to deal with that part, we will look into that. But first what you do is start writing up the solution of the early part, and let us see how to present the solution. In the solution, what you would first do is you would determine the terminal value at end of 5th year, which we are calling as P5. That is the terminal value of the business at end of 5 years from now. So what we know that is P0 equals to D1 upon KE minus G, where P0 stands for the current market price or the current value of the business, or you may also call it as a present value of the business. D1 is the expected cash flow by year end. KE is the cost of capital or equity capitalization rate. You may consider this as expected rate of return by the shareholders as well. And G stands for growth rate. So applying the same logic, what you will get is P5 equals to D6 upon KE minus G. So what we are going to do, whether we are going ahead with the merger or not, but in either case the terminal value will be determined this way. So we are going to apply this logic and determine the terminal value at end of 5th year, because thereafter the constant growth rate has been informed. So do one thing, write up these contents and then we shall move ahead. Alright friends, you would have finished writing these. Let us move ahead and make the calculations of P5. So without merger, D6 would be 350 plus 5%, that is 367.5, and therefore P5 will be D6 upon KE minus G. Substituting the values, you get 367 divided by 0.15 minus 0.05, and that would result into 3675 in rupees lakhs. With merger, what will happen? D6 will be 620 plus 6%. First of all, because of merger, the cash flows of 5th year is considerably higher, that is 620, and on top of that, the growth rate does not remain 5%, the growth rate becomes 6%. As a result, D6 value comes to 657.20. Now, P5 will be D6 upon KE minus G, and when you apply these calculations, what you get is 7302.22 in rupees lakhs. So friends, write up these calculations also, and then we shall move ahead. Alright friends, you would have finished writing this as well. Let us move ahead and take the calculation of value of business of Yes Limited at present without merger. Now this is going to be simple. You are just going to find the present value of the future cash flows. So we will write up years 1, 2, 3, 4, 5 and 5. 5 has been written 2 times. This 5 for the usual cash flow and this 5 for the terminal value that we have determined in the earlier working. So we are just copying the cash flows from the question. So first 5 years cash flows given. This terminal value at the end of 5th year we have found earlier in the previous working. And now PV factors were also informed in the question. Don't make a mistake over here. This is repetition of 5th year, so whatever factor you write over here should be written over here as well. Alternatively, you may add up the cash flows of 5th year along with this terminal value, but I would prefer keeping the calculations separate. And now PV of cash flows will simply be the cash flows multiplied by PV factors, and when you take the total, you get the value of business of Yes Limited without merger. So friends, take note of all these calculations and then we shall move ahead. Alright friends, after writing the calculations of present value without merger, we make a similar calculation, that is present value of the business, that is after merger. That means if the merger takes place, what would happen to the present value of the business. So we are going to make the same calculation, same way. Only thing is the cash flows that you would now take will not be the cash flows without merger, but the cash flows with merger. Never to forget, cash flows of year 1 to 5, these figures are already informed in the question, and this amount we have computed in the earlier working in the form of terminal value. Write up the PV factors, multiplying these PV factors to the cash flows, you will be getting present value of cash flows, and aggregate of these present values will indicate the value of the business of Yes Limited at present if the merger takes place. So note down all these calculations and then we shall move ahead. Alright friends, you would have finished writing these calculations. So we have worked out the value of business of Yes Limited before and after the merger. Obviously the value will increase after the merger. Difference between these two values will be what we would call as value of acquisition. So value of merged entity we have taken as 5308.47 lakhs, and the value of Yes Limited without merger was 2708.92 lakhs. Finally what you get as a difference is the value of acquisition. So this is the value of acquisition, 2599.55 lakhs. Now friends, they have asked you to work out the gain in value to shareholders of Yes Limited. So the first time you are coming across this kind of calculation requirement. Now this is very different type of calculation. Please pay attention to what I am trying to say. See, they are asking you to find the gain to whom? To the shareholders of Yes Limited because of this merger. So friends, first of all, what has been informed, the number of shares of both the companies, Yes Limited and No Limited, were same number of shares before merger. Check, this has been given to you, right? Now, the swap ratio is 0.5:1. That means for each share of No Limited, you are offering 0.5 share of Yes Limited. So just imagine, before merger, both Yes and No Limited had same number of shares. Now you are taking away No Limited's share and giving shares of Yes Limited with a swap ratio of 0.5. That means whatever number of shares you take, you are offering half the number of shares. And now what will happen? We would see that the shareholders of No Limited will now have half the number of shares what they were having earlier, and shareholders of Yes Limited have no change in the number of shares they are holding. In simple words, before merger, if Yes and No Limited both have same number of shares, after merger, the shareholders of No Limited will have half the number of shares of Yes Limited. That means half the number of shares compared to the shareholders of Yes Limited. If you don't understand, let us take an example so that this point should be very clearly fit into your mind. You may take an assumption that before merger, both the companies had 1 lakh shares. Okay, we have just assumed. We need not write up that in the solution, but we have just assumed that we have 1 lakh shares in case of both the companies before merger. Swap ratio being 0.5, you would have taken away No Limited shares, that is 1 lakh shares, and given 50,000 shares only, half, right? 0.5 is the swap ratio, so half the shares given, 50,000 shares given. Now Yes Limited's original shareholders have 1 lakh shares as it is, and now No Limited's shareholder who have recently become shareholders of Yes Limited will have 50,000 shares. As a result, the merged entity total number of shares will be 1 lakh plus 50,000. Now check. If you find the shareholding pattern, original shareholders of Yes Limited hold 1 lakh shares, and the new shareholders who were earlier shareholders of No Limited, now becoming shareholders of Yes Limited, will have 50,000 shares only. So we can say the shareholding of original shareholders of Yes Limited is double the number of shares held by the shareholders of No Limited, 1 lakh and 50,000. So double the number of shares. So after merger, if you look into the shareholding pattern, the original shareholders of Yes Limited will hold 2/3 of the shares in the merged entity, and the shareholders of No Limited will hold only 1/3 of shares in the merged entity. So taking forward our example, if there were 1 lakh shares before merger, after merger 1 lakh of Yes remains as it is, 1 lakh shares of No Limited were swapped with 50,000 shares of Yes Limited newly issued. So it is in total 1,50,000 shares. So 1 lakh shares compared to 1,50,000 shares is a 2/3 which is held by the shareholders of Yes Limited originally, and 50,000 compared to 1,50,000 will be 1/3 which is now held by the shareholders of No Limited. So the shareholding pattern becomes 2/3 and 1/3. Once you understand this 2/3 and 1/3 split, you will easily understand the gain in value to the shareholders of Yes Limited because of merger. So please pay attention over here. I'll show you how to write up the solution ahead. So what you can do is, Yes Limited and No Limited had same number of shares before merger, and swap ratio is 0.5:1. So I'm going to show the calculations ahead, but first what you do is write up whatever you find on screen right now. Alright friends, after writing this much, let us move ahead and compute that amount of gain. So after merger, the shares in the merged entity held by the shareholders of Yes Limited will be twice the number of shares issued to the shareholders of No Limited. Therefore, shares held by respective shareholders of Yes Limited and No Limited will be in the ratio of 2:1, that is 2/3 and 1/3. Therefore, share in value of merged entity owned by shareholders of Yes Limited will be 5308.47, that is the value of merged entity, into 2/3, that comes to 3538.98 lakhs, and the value without merger was 2708.92 lakhs. So because of merger, these people have got enhanced value, the additional value of 830.06 lakhs. So friends, carefully note down this part of the solution, and that will be end of the solution.
Alright friends, once you have completed writing this solution, let us move ahead and take up the next question. That will be question 3B. And this is picked up from the topic risk management, which in your textbook is question number 4. So let us deal with this.
Mr. Lazy holds a portfolio with two stocks X and Y. Stock X has a standard deviation of 4% per day and stock Y has a standard deviation of 6% per day. Mr. Lazy has invested rupees 8 lakhs in stock X and rupees 12 lakhs in stock Y. Stock X has a correlation coefficient of 0.72 with stock Y. Assuming 5 trading days in a week and using 99% confidence level, determine the maximum loss level over a period of 2 weeks, that is 10 trading days, and given that value of Z for 1% significance level from normal table of cumulative area is 2.33. So friends, the later part of calculation is going to be straight, but the early part here we are going to explore two different alternatives of determining the volatility in rupees. So let us see how to present the solution. In the solution, you would first determine the portfolio variance, and this is what you have been learning throughout the portfolio chapter. Sigma P square equals to sigma X square into WX square plus sigma Y square into WY square plus 2 times sigma X into sigma Y into WX into WY into correlation between X and Y. Let us put up the values given in the question. Sigma X is 4%, sigma Y is 6%, WX will be 0.4. Weights are basically the proportions of money invested, right? So weight of X or the proportion of
money invested on stock X is 40% or 0.4, and WY, that is weight of Y, will be 60%, that is 0.6. I'm sure you are able to trace out how we got this 0.4 and 0.6, correct? This 0.4 and 0.6 has been obtained from the fact that rupees 8 lakh has been invested in stock X and 12 lakh has been invested in stock Y. The total money invested is 20 lakhs. 20 lakhs divided into 8 lakhs and 12 lakhs would represent 40% investment in X and 60% investment in Y. Therefore, the resultant weights are 0.4 and 0.6 represented as WX and WY. I'm sure you understand this part of calculation, and correlation between X and Y is given as 0.72. Now, the portfolio variance can be determined by substituting all these values in this equation, and once you get the portfolio variance as 23.8144, square root of portfolio variance will be the standard deviation of the portfolio, and that comes to 4.88%. So volatility in value will be the value of portfolio multiplied by the standard deviation in percentage. So volatility in rupee will be, the portfolio value will be 20 lakhs into 4.88%, which is the standard deviation of the portfolio. So this is how you compute volatility in rupee when it is a case of portfolio. In case of single stock, it was just the stock value multiplied by standard deviation in percentage. In case of a portfolio, this additional exercise you will have to carry out. So do one thing, before we move ahead with the other alternative approach of making the same calculation, first note down this whole thing, and the result over here, the volatility in rupee will be rupees 97,600. So friends, write up this whole thing quickly and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Now this calculation of volatility in value with respect to the portfolio, that is 97,600, can be determined a little alternatively also. Now this approach, what we have first followed, is something that you have learned already in the portfolio chapter, but it is little longer to apply. We can have the other alternative approach as a quick approach. So let us see how to apply that. It is based on similar logic but directly taking the values. So here we would take Vp square equals to Vx square plus Vy square into 2 times Vx into Vy into correlation between X and Y. Now what are these Vx, Vy and Vp? Let us define. Vx is volatility in rupee for stock X, and which is 8 lakh into 4%, 32,000. Vy is volatility in rupee for stock Y, which will be 12 lakhs into 6%, that is 72,000. And Vp will be the volatility in value for the entire portfolio. So here Vp square equation is first traced out, and you can see when you apply this calculation, Vp square value comes to this. So Vp will be square root of Vp squared, and that will be square root of 0.952576, and that gives you 0.976. Notice one thing, because 32,000 and 72,000 we have taken as 0.32 and 0.72, these were basically values in lakhs, and therefore the final result will be in lakhs, and so Vp comes to exactly rupees 97,600. This alternative approach is also usable for making the same calculation. So both the approaches can be used by you, whatever you find more convenient and comfortable. So do one thing, you first note down this and then we shall move ahead. Alright friends, after writing up this alternative approach giving the volatility in value with respect to the entire portfolio as rupees 97,600, the part ahead is very simple. You can find VAR, that is volatility in value multiplied by Z value into square root of number of trading days. That means this part of calculation remains same whether it is a case of portfolio or even an individual stock. So question has informed the level of significance as 1%, and for that the Z value will be 2.33, and we have to make calculation for 2 weeks, that is 10 trading days, and that final result comes to rupees 7,19,127. So please note down this calculation as well. That will be end of the solution. Now here I would want to provide one extension in these calculations, though it was not demanded in the question. Now friends, we have always learned one thing in the portfolio topic, that portfolio can provide you the advantage of diversification, correct? So instead of putting all your money into single security, if you have a diversified investment portfolio, the risk could be minimized. So what we can do over here with the value at risk concept, VAR concept, we can identify how much risk we could actually save, how much risk we could actually reduce in value by creating a portfolio. So friends, I told you again, this part is not demanded in this question, but if the question requires you to make that additional calculation, that what was the benefit of diversification, compute by value and show that, you can just apply this extended calculation and show that. So why I haven't included that same thing in the basic question, because in your module in ICAI study material, this thing has not been demanded, not given, not explained, but I would say you should know how to do that calculation. So this part what I am showing now on screen can be considered as an extended part, and I am telling you again, in examination do this calculation only when the question is demanding this calculation, otherwise no need. Otherwise what you have shown over here is end of the solution. So friends, please carefully pay attention on the screen and note down that additional calculation, and this could show you the advantage of diversification which you have obtained by creating a portfolio. So in the circumstances and situations where the question is asking you the advantage of diversification or advantage of creating a portfolio, you would present the extended part of solution this way, that is VAR equation in the usual way. At 1% level of significance, the maximum loss that you can compute for 10 trading days, you compute individually for stock X, that comes to 2,35,779. You compute individually for stock Y, that comes to 5,30,504. Then take the aggregate of the two, which comes to 7,66,283, and the VAR for the entire portfolio, you can see it was lower than this aggregate, correct? So reduction in VAR due to diversification will be rupees 47,156. So friends, do one thing, take note of this whole thing and make sure that you are writing up this part only when specifically demanded in the question. Alright friends, once you have completed writing this solution as well, let us move ahead and take up the next question. That will be question 3C, which is picked up from the topic risk, return and portfolio theory, and in your book this is question number 35 from the portfolio topic. Let us deal with this. A portfolio manager has the following 4 stocks in his portfolio. So if you can observe what all information is available, we have 4 securities: VSL, CSL, SML and APL. The information is given with respect to number of shares of each security, the market price of each share and the beta of each of these 4 stocks. First thing what they have asked is compute the following, that is portfolio beta. Now you know one thing, portfolio beta will have to be the weighted average of betas of these individual stocks. And what are weights? Weights are the proportions of money invested in each stock. How will you find the proportion of money invested in each stock? Simply multiply the number of share of each type to its respective market price, and that product will give you the market value of your investment. So market value of investment of each security, once you add up, you will be getting the total amount invested, and what is the investment in VSL out of the total investment will give you the weight of VSL, and likewise you'll find the weight of other securities. So you can easily determine portfolio beta. Second thing what is asked, if the PM, that is portfolio manager, seeks to reduce the portfolio beta to 0.8, how much risk-free investment should he bring in? Now of course risk-free investment will have its beta as 0, that can be our assumption. In absence of any information, we will always assume that the beta of risk-free security will be 0. Thereafter, if you want to reduce the portfolio beta, you can definitely include some portion of your investment in risk-free securities, and that will definitely bring down your portfolio beta. We can work out that as well. And lastly, if they say, if the portfolio manager seeks to increase the portfolio beta to 1.2. Now, if you want to reduce the portfolio beta, you can add risk-free securities. If you want to increase the portfolio beta, you should remove the risk-free securities. If you don't have risk-free securities at all, then taking a negative position, in other words, taking a negative weight in risk-free security would actually mean borrowing in money market. Anyway, when we come to this third part, I'll explain the matter in details. As of now, let us proceed ahead with the solution and look into how to determine the portfolio beta. So what you would do is you just tabulate this information and you write up the names of securities along with the number of shares. Also consider the market price of each share and multiply the number of shares with the market price per share to get the amount invested. Of course, you have to take the total of amount invested. So to compute the weight of each security, you would consider the amount invested in a particular security divided by total investment. So 5 lakhs by 12 lakhs will be the weight of VSL, 1 lakh by 12 lakh will be weight of CSL, 2 lakh by 12 lakh will be weight of SML, and 4 lakh by 12 lakh will be weight of APL. Once you get the weight of these securities, you can comfortably compute the portfolio beta, which will be the weighted average of betas of these individual stocks. So betas are given in the question, weights we have just determined. So just apply this calculation and end of the equation you will be getting the portfolio beta value. So we have learned these things already in earlier question, how to compute portfolio beta, nothing new for you. So portfolio beta comes to 1.10833. So please write up these calculations and then we shall move ahead. Alright friends, I am sure you have finished writing this whole thing. Let us move ahead and now deal with the second requirement of the question, where the portfolio manager seeks to reduce the portfolio beta to 0.8. Currently the portfolio beta is 1.10833. So if you want to reduce the portfolio beta, it is obvious that some amount should be invested in risk-free securities. Now let the amount to be invested in risk-free securities be rupees X lakhs, and now what you do is you just consider portfolio beta after inclusion of risk-free securities. It will be weighted average of beta of your stocks and beta of risk-free securities, and of course the weighted average will require the weight of stocks and weight of risk-free securities. Now please understand one thing, we have considered the value of that risk-free security as in rupees lakhs. So the value of your stocks will also be mentioned in rupees lakhs. So what I am going to do is 12 lakhs is the amount invested in stocks, 12 lakhs, and X lakhs is the amount invested in risk-free securities. So 12 lakhs plus X lakhs, in terms of lakhs of rupees, your investment value will be 12 plus X. So what will happen, your portfolio beta has to be targeted to 0.8. Then beta of stocks we have already computed, the beta of those 4 securities, the weighted average beta of those 4 securities is basically beta of stocks. Now what will be the weight of stocks? Total investment will be 12 plus X and investment in stock is 12. So 12 divided by 12 plus X will be the weight of stocks, and x divided by 12 plus x will be the weight of risk-free securities. The beta of risk-free securities is assumed to be 0 and beta of stocks we have already computed like this. As a result, when you solve this whole equation, you will be getting the value of x. Let us write that assumption also, that beta of risk-free security has been assumed to be 0. So always, in absence of information, you will always consider the beta of risk-free securities as 0. Before we solve this equation and go ahead, please write up this content and then only I'll take you ahead. Alright friends, once you have finished writing this whole thing, let us move ahead and solve that equation. When you solve that equation, what you get exactly is 13.3 divided by 12 plus x will give you 0.8. So cross multiply, 12 plus x will be 13.3 divided by 0.8 and 12 plus x will be 16.625. So value of x will be 16.625 minus 12, that will be 4.625, but because x was considered as investment in lakhs of rupees, it is basically 4.625 lakhs or rupees 4,62,500. The portfolio manager should invest rupees 4,62,500 in risk-free securities. So please write up this part of the solution and then we move ahead with the next part. Alright friends, I am sure you have finished writing this whole thing. Let us move ahead, and what we do now is we deal with the third part. In the third part, the portfolio manager is expecting the overall portfolio beta to go to 1.2. Now this is little tricky, please pay attention. Without inclusion of risk-free securities, your portfolio beta of those 4 stocks was 1.10833. Now if you want to reduce the portfolio beta, you have to increase the risk-free asset. If you want to increase the portfolio beta, you need to reduce the risk-free asset. Now because there are no risk-free assets included in these 4 stocks, instead of reducing the risk-free asset, what you can do is you can increase the risk-free liability. In other words, instead of investing in risk-free securities, you borrow money at risk-free rate. That means your investment in risk-free securities will be a negative investment or it will contain a negative weight. So it is obvious that some amount should be disinvested or borrowed in risk-free securities. Now the manner of solution will be the same. So what will happen, you write up the same equation in the same style, but this time do you notice what we have done? In the left side, beta value is not 0.8, beta value is 1.2 and beta of risk-free securities is assumed to be 0 here also. So same style of solving the question, but when you end up solving, the value of x that you get now will be a negative value, which will indicate not investment in risk-free securities but in fact borrowing at the risk-free rate. Now that negative value of x will basically indicate not an investment in risk-free securities but borrowing at risk-free rate. This point you should very clearly understand, that instead of x value being positive, if x value comes to negative, you are not going to invest in risk-free securities. In fact, at the money market, you are going to take a position of borrowing. In other words, you will have a negative weight of your risk-free securities, and we have already learned negative weight does not mean making an investment. Negative weight indicates borrowing. So if it is negative weights in stocks, you end up borrowing stocks, but if it is a negative weight in risk-free securities, you end up raising a borrowing in money market at risk-free rate. So we will conclude that definitely. But first what you do is write up this whole thing, what is there in front of you on the screen. Alright friends, I am sure you have finished writing this whole thing. Let us move ahead and we solve this equation taking 1.2 in the left hand side. The right hand side value remains same. So when you cross multiply, 12 plus x will be 13.3 divided by 1.2, and 12 plus x comes to 11.0833. Value of x will be negative 0.91667. So basically it is a value in lakhs of rupees, so it will be negative 91,667, and therefore the portfolio manager should borrow rupees 91,667 at risk free rate. So keep in your mind one thing very well: in portfolios, when the weights are positive with respect to any security, you end up making investment in that particular security. If the weight is negative, you are not investing but borrowing. So when it comes to a negative weight with respect to a risk free security, it basically means that you are borrowing from money market. So please write up this whole thing, and that will be end of the solution. Alright friends, once you have completed writing the solution, let us move ahead and take up the next question. That will be question 4a, and this one is picked up from the topic mergers and acquisitions, which in your textbook is question number 12. Let us deal with this.
Consider the following data for the two companies, Acquirer Limited and Target Limited. What has been given is number of equity shares, market price per share, and price earning ratio. Acquirer Limited considers acquisition of Target Limited and offers for a stock swap on the basis of market price. However, Target Limited demands the stock swap on the basis of EPS. It was finally negotiated to provide to the shareholders of Target Limited the average of lower and upper limit of number of shares determined as per the two modes mentioned above. It is expected that the overall profit of the merged entity will increase by 25% due to effects of synergy. Assuming that the PE ratio of Acquirer Limited remains unchanged after the merger, you are required to determine the following. Number 1, swap ratio and the number of shares to be issued as consideration, followed by post-merger earnings per share and equivalent EPS for shareholders of Target Limited. Then they have further asked post-merger market price per share, gain or loss in value to the shareholders of both the companies, loss in earnings for shareholders of Target Limited. Considering the synergic effects, are the shareholders of Target Limited better off on the basis of the following parameters? Number 1, market capitalization, and number 2, total earnings. So friends, before we approach the solution, let us first understand the given scenario in this question. If you carefully look into what has been given, the question is giving you two new points which you haven't seen earlier. Point number 1, you would see that the acquirer is offering a stock swap on the basis of prevailing market prices. On the other side, the target company, it is demanding the stock swap on the basis of EPS. That means they both are not able to arrive at a common consensus. As a result, they have finally negotiated that whatever be the number of shares from both the bases, let the number of shares to be issued be the average of the two different number of shares what you have obtained by two different modes. So what happens? Generally what you have seen in the past, when the acquisition is on the basis of market price, what happens to the shareholders of target company after merger? We have seen that they generally suffer with loss of their earnings, correct? And therefore, for being indifferent with their earnings, they would always demand more number of shares, and generally they would demand the stock swap on the basis of EPS. So what will happen when you apply the stock swap on the basis of market price per share? You will be getting lesser number of shares to be issued as a consideration. On the other side, when you consider EPS as the basis of acquisition, the number of shares to be issued as a consideration will increase. So now this question is talking about these two different number of shares as lower limit and upper limit. Lower limit on the basis of market price per share and upper limit on the basis of earnings per share. Finally, you will be taking the average of this lower and upper limit of number of shares to arrive at the number of shares to be issued effectively, and that will become the basis of the effective swap ratio for this consideration. That was one different point in this question. Another second different point in this question was, first time we have seen that synergic effect has been informed. So friends, this part is no big deal. I have explained you earlier what could be the meaning of effect of synergy, but let me explain you once again. What happens when the two companies generally working in similar business line, they merge? What will happen? Because of the improved efficiency and economies of scale, or because of the functional efficiency, because of elimination of competition between them, there may be lots of aspects which rises the profitability of the merged entity. In other words, if the acquirer limited was earning X amount of profit, if the target company was earning Y amount of profit, the post merger total earnings without synergy would be X plus Y, but with synergic effect it will be a little more than X plus Y. So here the question is informing you that the synergic effect will be 25% additional earnings. That means whatever be X plus Y, that is the aggregate earnings of the acquirer company and target company on a pre-merger basis. On that you add 25%, and finally you come to know what would be the post-merger total earnings. That will become the basis for computing post-merger EPS and all the follow-up calculations. Lastly, they have also asked, are the shareholders of target company better off because of this synergic effect? Considering the synergic effect, what do you conclude? Are the shareholders of target company better off or not? We have to identify that. So friends, other than these few points, this question has all the typical requirements what we have seen in other questions. So let us see how to present the solution. In the solution, we would first begin with the swap ratio based on market price that was suggested by the acquirer company, that is named as Acquirer Limited. So obviously the swap ratio would be market price per share of target company divided by market price per share of acquirer company, and market price per share of both these companies are given as 80 for target and 400 for the acquirer. That would give you the swap ratio as 1/5 or 1:5. That means one share of acquirer company should be given for every 5 shares held in the target company. As a result, the number of shares to be issued on the basis of market price will be the number of shares in target company multiplied by the swap ratio that you have just computed as 1/5. And we have been informed that there are 4 lakh shares in the target company. So 4 lakh into 1/5, that will be 80,000 shares. As I have explained you earlier, this 80,000 shares will be the lower limit of number of shares to be issued. So friends, before we move ahead, write down all these calculations quickly. Alright friends, you would have finished writing all these calculations. Let us move ahead and talk about the EPS. EPS was not informed in the question directly, but we know one thing very well, that the price earning ratio, if you want to find, it is market price per share upon EPS. So EPS can be determined by dividing the market price per share by the price earning ratio. So for the acquirer company, the EPS would be 400 divided by 16, that is rupees 25. And for the target company, it would be 80/4, that is rupees 20. So now, if these are the EPS of the two companies, what is the suggestion or what is the requirement of the target company? Target company has demanded the stock swap on the basis of EPS, and that would mean swap ratio this time will be EPS of target company divided by EPS of acquirer company. That will be 20 divided by 25, or you may simply say 4 by 5. That means 4 shares of acquirer company shall be issued for every 5 shares held in target company. And now we have yet to compute the number of shares in this regard, but first what you do is write up quickly whatever you find on the screen. Alright friends, you would have finished writing all these calculations. Let us move ahead and now determine the number of shares to be issued when the swap ratio is based on EPS. So the number of shares to be issued will always be the number of shares in target company multiplied by swap ratio. So that will be 4 lakh into 4 by 5, because we have just found that 4 by 5 will be the swap ratio based on EPS. You will be finding that the number of shares to be issued will be 3,20,000 shares, and now this 3,20,000 shares will be considered as upper limit. And now what they have agreed, the effective number of shares to be finally issued will be the average of this upper and lower limit. So as negotiated, the number of shares to be issued will be the average of lower and upper limit. That number of shares will be 80,000 shares plus 3,20,000 shares divided by 2, and that comes to 2 lakh shares. Finally, what we find is the total number of shares in target company were 4 lakh shares, and the final number of shares that you are issuing are 2 lakh shares. So effectively the swap ratio will be 2 lakh divided by 4 lakh, that is 1 by 2. So all the calculations ahead, wherever we will need the swap ratio, the effective swap ratio will be actually 1 by 2. So friends, write up these calculations also, and then we move ahead. Alright friends, let us move ahead and take up the other calculations. So we would first arrive at the post-merger total earnings of acquirer limited. What we generally do, we take the pre-merger earnings of both the companies, and what we have been informed this time, we don't know the profit of the two companies on overall basis, but we know the number of shares, and we have also determined EPS. Number of shares into EPS will give you the total earnings before the merger. So acquirer limited and target limited both computed, you are going to take the aggregate as total earnings. Now this same thing could have been the post merger total earnings, but because of the effect of synergy, you are simply going to add 25% of 3 crore 30 lakhs, that will be 82 lakh 50,000. And finally what we conclude, that post merger total earnings of acquirer limited will be 4 crore 12 lakh 50,000 after considering the effect of synergy. And we will also work out the post merger total number of shares. That will be the original number of shares of acquirer company plus the number of shares it has issued for acquire the target company. So it is 10 lakh initial number of shares plus 2 lakh, that will be the additional shares issued as consideration. So post merger number of shares will be 12 lakh shares. So friends, before we move ahead, write up all these calculations quickly. Alright friends, let us move ahead and take up the other calculations. Post merger EPS is what we have to determine. For that we need post merger total earnings divided by post merger total number of shares. We have now both of these information clearly available. So that will be 4 crore 12 lakh 50,000 divided by 12 lakh shares, and that will be rupees 34.375. The question has also demanded the equivalent EPS for shareholders of target company, and we have been doing this calculation quite a lot of time. It will be post merger EPS, that is this, multiplied by the swap ratio, and the effective swap ratio what we have gathered over here is 1:2 or simply 1 by 2. So it will be 34.375 into 1 by 2, that will be 17.1875. Let me once again remind you what you have to do with this equivalent EPS from the viewpoint of target company. This has to be compared with the pre-merger EPS of target company to arrive at gain or loss in earnings to the shareholders of target company. So if you compare, the pre-merger EPS was rupees 20. Even after considering the synergic effect, the equivalent EPS what you find in the hands of the shareholders of target company is less than 20, correct? That means earnings viewpoint, the shareholders of target company are definitely not happy. Anyway, let us move ahead. We will write up those conclusions later. But first we work out the post-merger market price per share. That will be again very simple. That is post-merger EPS multiplied by price earning ratio. The price earning ratio of acquirer company was 16 times. So 34.375, that is post-merger EPS multiplied by price earning ratio 16 times will give you post-merger market price per share as rupees 550. So friends, note down these calculations and then we shall move ahead. Alright friends, you would have finished writing all these calculations. Now, after computing the post-merger EPS and post-merger market price per share, you are ready to determine the gain or loss to the shareholders of both the companies. And this type of calculation we have done quite a lot of times earlier. So what you have to do is determine gain or loss to the shareholders of both the companies. This gain or loss will be determined in terms of value. So the question has asked you both the parameters, that is from the viewpoint of earnings as well as from the viewpoint of value. So we will talk about that earnings little later, but what we have just computed, current market price per share, that is post merger market price per share being rupees 550, how does that benefit the shareholders of both the companies in terms of value? So let me remind you how we do this. We consider the post merger number of shares in the hands of both the companies' shareholders. To that we multiply the post merger market price per share to obtain the post merger market capitalization in the hands of the shareholders of acquirer company as it was originally, and in the hands of shareholders of target company who have now just become the shareholders of this acquirer company. So when you compare that pre-merger market capitalization and post-merger market capitalization, you will come to know what is the difference in value in terms of gain or loss. So let us see how to present the solution. So presenting this part of solution is again as usual. You are going to calculate the gain or loss to shareholders in terms of market capitalization, that you should not forget. And for that purpose, you should first start with the number of shares after the merger. So the acquirer limited shareholder, originally they had 10 lakh shares, and target limited shareholders who originally were the shareholders of Target Limited have now become shareholders of this acquirer company, and they have just received 2 lakh shares. So these are the number of shares in the merged entity that both the categories of shareholders are currently holding. And the merged entity in total 10 lakh plus 2 lakh, it is 12 lakh shares. Post merger market price per share 550 we have just obtained earlier in the previous working. Multiplying this, we get post merger market capitalization, and that is 55 crores for acquirer limited, and for Target Limited it is 11 crores. Pre-merger market capitalization, it was 40 crores for acquirer limited and 3 crore 20 lakhs for Target Limited. Now how do we get these? The pre-merger number of shares of each company should be multiplied to the pre-merger market price per share to get this value. And finally, what we find, that because of merger, the gain in value, it is 15 crores gain in value for shareholders of acquirer limited and 7 crore 80 lakhs for shareholders of Target Limited. The merged entity in all has a gain of 22 crores 80 lakhs. So friends, before we move ahead, please take note of this much quickly. Alright friends, you would have finished writing all these calculations. Let us move ahead and write up the answer for the other parts. We would want to now determine the loss in earnings for shareholders of Target Limited. I gave you hint earlier that the pre-merger EPS of Target Limited's shareholder was rupees 20, but the equivalent EPS what we have computed was lower than 20. To be more specific, the equivalent EPS for the shareholders of Target Limited is 17.1875. So there is a loss of earnings in terms of per share, and multiplied by pre-merger number of shares, 11,25,000 is the loss of earnings for the shareholders of Target Limited. So we can conclude one thing very well, that on the basis of market capitalization, the shareholders of Target company are better off, but in terms of their earnings, overall basis, their earnings have got reduced by 11,25,000 in total, and therefore from the viewpoint of earnings, they are definitely worse off than earlier. So write up that concluding part as well. We would say on the basis of market capitalization, the shareholders of Target Limited are certainly better off due to merger. This is because the total market capitalization held by these shareholders have increased by 7 crore 80 lakhs. Do you recollect? It was 3 crore 20 lakhs earlier, and now it has become 11 crores. So it has increased by 7 crore 80 lakhs. So the percentage increase, if at all you want to find, it will be 243.75% increase. So friends, do one thing, write up this part, and then I'll show you the percentage loss of earnings also. And we would conclude that from the viewpoint of earnings, they are worse off than earlier. However, from market capitalization viewpoint, what you find on screen, they are certainly better off. So write up this part quickly, and then we move ahead. Alright friends, let us move ahead and write up that last concluding part, that on the basis of earnings, the shareholders of Target Limited are worse off than earlier because the total earnings as well as the equivalent EPS has reduced significantly. The percentage loss in earnings will be pre-merger EPS minus equivalent EPS divided by pre-merger EPS. That will be 20 minus 17.1875 divided by 20. By percentage, it comes to 14.0625%. So friends, take note of this calculation also, and that conclusion will be the end of the solution.
Alright friends, once you have completed writing this solution as well, let us move ahead and take up the next question. That will be question 4B, and this one is picked up from the topic International Financial Management or FDI, and that will be question number 9 from your textbook. Let us deal with this question.
Opus Technologies Limited, an Indian IT company, is planning to make an investment through a wholly owned subsidiary in a software project in China with a shelf life of 2 years. The inflation in China is estimated as 8%. Operating cash flows are received at year end. For the project, an initial investment of Chinese yuan 30 lakhs will be in land. The land will be sold after the completion of the project at estimated value of Chinese yuan 35 lakhs. The project also requires an office complex at cost of Chinese yuan 15 lakhs payable at beginning of the project. The complex will be depreciated on a straight line basis over 2 years to a zero salvage value. This complex is expected to fetch Chinese yuan 5 lakhs at end of the project. Further given, the company is planning to raise the required funds through GDR issue in Mauritius. Each GDR will have 5 common equity shares of the company as underlying security, which are currently trading at rupees 200 per share. Face value is just rupees 10 in the domestic market. The company has currently paid dividend of 25%, which is expected to grow at 10% per annum. The total issue cost is estimated to be 1% of the issue size. The annual sale is expected to be 10,000 units at the rate of Chinese yuan 500 per unit. The price of the unit is expected to rise at the rate of inflation. Variable operating costs are 40% of sales. Fixed operating cost will be Chinese yuan 22 lakh per year and expected to rise at the rate of inflation. That means the rate of inflation commonly applies on your sales, on your variable cost as well as on your fixed operating cost. The tax rate applicable in China for income and capital gain is 25%, and as per GOI, that is Government of India policy, no further tax shall be payable in India. The current spot rate of Chinese yuan 1 is rupees 9.5. The nominal interest rate in India and China is 12% and 10% respectively, and the international parity conditions hold. That means you are going to apply the purchasing power parity definitely over here, and these cash flows can be discounted at nominal interest rate. Nominal interest rate means these are directly given as the money interest rate or money discounting rate. That means these are inflation adjusted discounting rates. Now, you are required to identify the expected future cash flows in China and determine NPV of the project in Chinese yuan. That means first of all, they want you to identify all the cash flows in China, and you want to now determine the NPV of the project in Chinese yuan. That means the approach that you have to follow is the foreign currency approach. Further given, determine whether Opus Technologies Limited should go for the project or not, assuming that neither there is restriction on the transfer of funds from China to India nor any charges or taxes payable on the transfer of funds. This question, we are going to first determine the NPV in Chinese yuan. We will also determine the NPV in Indian rupee and look into whether the project is acceptable or not. So let us see how to present the solution. In the solution, you would first determine your cost of capital through issue of GDR, and for that you know one thing, that the net issue size is Chinese yuan 45 lakhs, and you know one more thing, that the cost of the issue will be 1%. That means the proceeds in your hand will be just 99% of the gross issue size. So gross issue will be Chinese yuan 45 lakhs divided by 99%, and what you get is Chinese yuan 45 lakh 45,455. Issue price per GDR will be 200 into 5 into 100%. Why? So 200 basically is the market price of the share in India, that is in Indian rupee, and there are 5 shares underlying each GDR, and because the gross issue price is considered, you are taking 100%, and that will come to INR 1000, that is Indian rupee 1000. So friends, if you wanted to convert this in terms of Chinese yuan, the spot rate is given to you as 1 Chinese yuan equals to Indian rupee 9.5. You may convert this in terms of Chinese yuan also, but dividing it by 9.5 would again give result in fraction. So I have preferred keeping this in terms of INR. Because we have found issue price per GDR in Indian rupee, we will find dividend per GDR also in Indian rupee. First of all, the current dividend that is considered as D0 is given as 2.5. Growth rate in dividend is basically 10%. So 2.5 plus 10% will give you the dividend per share, and there are 5 shares underlying each GDR. Finally, what you will get is INR 13.75 as dividend per GDR. However, the net issue proceeds will not be 1000 rupees, right? The net issue proceeds will be basically only 99% of the gross issue proceeds, and that will be rupees 1000 into 99%, and that will be rupees 990. So when you calculate KE, understand one thing, all these calculations we have kept purposely on INR basis. It does not matter at all whether you take INR or CNY, because the KE calculation will anyway be in percentage. So just take one care. If the numerator is in INR, denominator also has to be in INR. That is all. So please note down all these calculations and then we shall move ahead. Alright friends, you would have finished writing these calculations. Let us move ahead and compute the forward rates for the next 2 years, and that will be simply be done by taking spot rate into 1 plus IL upon 1 plus IF. Spot rate is given as 1 Chinese yuan is rupees 9.5. IL stands for interest rate prevailing locally and IF stands for interest rate prevailing in foreign country. So for the first year, FFR will be 9.5 into 1.12 divided by 1.1, that gives you 9.67. For the second year, 9.67 will become the basis and the calculated value for the second year is 9.85. So do one thing, quickly take note of these calculations also and then we shall move ahead. Alright friends, you would have finished writing these calculations as well. Let us move ahead and determine the post-tax realizable values of assets after 2 years on completion of the projects, and this calculation will be obviously in the Chinese currency, that is in CNY. So we have two assets, land and building. The realizable value of land is given as 35 lakhs CNY and for building it is given as 5 lakhs. From this we will subtract the WDV. Now land not being a depreciable asset, its WDV will be the same amount what you have incurred as cost. The cost of land was 30 lakhs and in case of building, the depreciation of the entire cost has been charged already over 2 years on a straight line basis. So WDV of building is 0. Capital gain will be the realizable value minus WDV, which is 5 lakhs in each case. Tax on capital gain will be at 25%, which is 1,25,000 Chinese yuan in each case. Finally, what you get is the realizable value and the tax on capital gain. We have identified the realizable value as A and tax on capital gain as B. So finally, what you get as net realization post tax in Chinese yuan as A minus B, that will be 33,75,000 for land and 3,75,000 for building. So the net realization post tax in Chinese yuan will be aggregate of 33,75,000 and 3,75,000, and that would give you 37,50,000. So friends, take note of these calculations also and then we shall move ahead. Alright friends, you would have finished writing these calculations as well. Let us move ahead. The next thing that you would want to calculate is the annual cash flows for 2 years of operations. The project has life of just 2 years. So this calculation is going to be very simple. Annual sales quantity is given as 10,000 units for each year. Selling price for year 1. Now 500 Chinese yuan is the base price and inflation rate in China is 8%. This was the price given as base price, that was the real cash flow kind of price. Inflation has to be accommodated. So 500 into 1.08 would give you 540 as the price for first year, and for the second year it will be 500 into 1.08 squared and that would give you 583.20. Multiplying the number of units to the selling price per unit would give you annual revenue in Chinese yuan. From this you subtract the variable operating cost, which is 40%, and then what you get is the contribution part. Subtract the fixed operating cost. Here also the inflation has to be considered as 8% per annum. So the amounts will be the amounts what you have written over here. These are with 8% inflation adjustment here for year 1 and here for year 2. Now from this we would also subtract the depreciation. Depreciation is simply 15 lakh divided by 2 years for the office complex, correct? So that will be 7,50,000 each year. Subtracting these, we would be getting the earnings before tax. From this you subtract the tax and you arrive at the profit after tax. So the profit or earnings after tax, on these earnings you are going to add back depreciation, and depreciation added back, what you will get finally is cash flows. So cash flow for year 1 and year 2, you should understand this thing very well. Both these cash flows are in Chinese yuan. So we have not made any cash flow calculation in Indian rupee. All the figures that appear in front of you are in Chinese yuan. So do one thing, take note of all these calculations and then we shall move ahead. Alright friends, you would have finished writing these calculations also. Once the cash flow calculation is over, you are ready to calculate the NPV. So 0, 1, 2 and 2. The year column contains 0 for the initial outflows, and year 2 has been written twice. One is for the usual cash flows and this is for the terminal value. So at 0 year, the cash flow in Chinese yuan will be 45 lakhs of outflow. These two are computed cash flows for the 2 years of operation, and this amount we have computed as the cash flows on termination of the project. All cash flows are in Chinese yuan. 11.39% is the discounting rate. We have already worked out this rate, correct? Basically this rate is the cost of capital through issue of GDR, correct? And because it is cost of capital through issue of GDR, this is nothing but the discounting rate for the cash flows in Chinese yuan. So this is not the RADR of the project in India, this is RADR of the project in China. Now PV of cash flows in Chinese yuan. To compute this, you have to first plot the PV factors at 11.39% and then multiply these PV factors to this cash flow values, and you get finally PV of cash flows in Chinese yuan. All outflows and inflows have been considered. So finally what you get directly will give you NPV of the cash flows, and that comes to negative 12,645 in terms of Chinese yuan. So do one thing friends, before we conclude anything further, please write up these calculations. Alright friends, you would have finished writing these calculations. Because the question has demanded the NPV computation in Chinese yuan, we did the same. However, if you wanted to determine the NPV of the project in Indian rupee, you might have considered the RADR of the project in India. Now what we do is, we know the formula. The RADR in foreign currency would be 1 plus RADR local into 1 plus risk-free rate in foreign country divided by 1 plus risk-free rate in local country. So substituting all the values in the above formula, check what we get. RADR in foreign country, that is in China, was 11.39%, written as 0.1139. RADR local is not known. We have that calculation yet to be determined. 1 plus risk-free rate in foreign country was 10%, so 1.1, and 1 plus risk-free rate locally, which was 12%, so 1.12, and from this whole thing subtracting 1. To solve this equation, let us send this minus 1 to the left hand side. It will come to the left and get added, so that will be 1.1139 in the left hand side. And what we simultaneously do, this part of the fraction 1.10 divided by 1.12, when you shift it to left hand side, it gets inverted, right? So it will be 1.12 by 1.10, and in the right hand side you continue to get 1 plus RADR local. So now if you would want to find the value of RADR local, this one also should be sent to left hand side. In other words, what you will get in the left hand side, 1.1139 into 1.12 divide by 1.10, from that subtract 1, and what you get is RADR local, and finally RADR local comes to 13.415%. So note down these calculations as well, and then we shall move ahead. Alright friends, you would have finished writing these calculations. Through this calculation, we got the RADR that will be applicable for that project in India, that will be 13.415%. Now, what we do is we follow the local currency approach and discount the cash flows in Indian rupee via the RADR prevailing locally. So, local currency approach, what you would do is first copy the cash flows in Chinese yuan. Now apply the exchange rates that you have determined earlier. You will be able to convert the cash flows in Indian rupee, correct? After doing that, the present value calculations you will be determining through the RADR local, that is 13.415. So these are the PV factors, and when you calculate the PV of the Indian rupee cash flows, these Indian rupee cash flows multiplied by these PV factors, you will be getting the PV of cash flows in Indian rupee, and when you do that, finally the NPV comes to negative 1,15,520. So this is the follow-up of the local currency approach. So friends, do one thing, write up all these calculations, and then I'll give you a very, very important point of conclusion after you have finished writing this. Alright friends, let us move ahead and write up the conclusion. So we would simply write the conclusion as, for Opus Technologies Limited, the NPV of the project is negative even if the cash flows are remitted to India on regular basis. Therefore, the company should not accept this project. Now friends, here one point I would want you to consider importantly: when you see the same question solved in your study material given by ICAI, there is a slight difference in the presentation of solution at the last part. You could see we have computed the NPV through local currency approach by using the discounting rate, which is RADR local, which was 13 point some percentage. Now, in your module, in your study material, the NPV in Indian rupee they have computed using 12%, which is not appropriate because 12% is the inflation adjusted discounting rate in India without considering the risk element. So that was not RADR, correct? The risk free rate in China was 10 and in India was 12. So if the risk adjusted rate in China is 11.39%, RADR in India cannot be 12%. It has to be worked out as 13.415%, whatever we calculated earlier, in that way. Because the module has given solution with 12% discounting rate, when they determine NPV in Indian rupee, they get a positive NPV. This is not appropriate, my friends. I am still giving this note. If you don't want to follow my opinion on this, you may follow what ICAI has done in its study material. Anyway, please write up the conclusion and this supporting note as well, and that will be end of the solution.
Alright friends, once you have completed this solution, let us move ahead and take up the next question, that will be question 4C. Now this is picked up from the topic interest rate risk management, and as per your textbook it is question number 7. Let us deal with this.
Messrs. Parker and Company is contemplating to borrow an amount of rupees 60 crores for a period of 3 months in the coming 6 months time from now. The current rate of interest is 9% per annum, but it may go up in 6 months time. The company wants to hedge itself against the likely increase in interest rate. The company's banker quoted an FRA at 9.3% per annum. What will be the effect of FRA and actual rate of interest cost to the company if the actual rate of interest after 6 months happens to be 9.6% per annum and 8.8% per annum? So the question has given you two possibilities. Under both the possibilities, we would want to find out the settlement amount which would indicate either the gain or a loss. So friends, please try to understand this line of the question. Company wants to borrow for a period of 3 months in coming 6 months time from now. So it will be basically 6 by 9 FRA, correct? So in the question, the rate of interest quoted by bank is 9% and the reference rate at one place is given as 9.6% and at other place it is given as 8.8%, and we have agreed to borrow at 9. So if the reference rate is 9.6%, obviously we will make gain, and if the reference rate is 8.8%, we will incur loss. So let us see how to present the solution. In the solution, we would first write up the settlement amount formula. We would define all these variables exactly the way we have seen in the earlier example, and then substitute the value of each of these variables in that formula and make the calculation and arrive at the settlement amount. This, what you find, is the outcome of case 1. So the case 1 results into a gain of rupees 4,39,453. Note down this and then I take you ahead. Alright friends, that was case 1. Now let us move to the second case where the settlement amount formula remains the same. Okay, you just have to now substitute the different values. Basically only one value is changing, the reference rate. Other things remain same in the question, and this time it is a case of loss, and the amount of loss is rupees 7,33,855. Note down this as well, and that will be end of the solution.
Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question. That will be question number 5A, a question picked up from mutual funds, and as per your textbook it is question number 15. Let us deal with this. On 1/4/2022, ABC Mutual Fund issued 20 lakh units at rupees 10 per unit. Relevant initial expenses involved were rupees 12 lakhs. It invested the funds so raised in capital market instruments to build a portfolio of rupees 185 lakhs. During the month of April 2022, it disposed of some of the instruments costing rupees 60 lakhs for rupees 63 lakhs and used the proceeds in purchasing securities for rupees 56 lakhs. The fund management expenses for the month of April 2022 was rupees 8 lakhs, of which 10% was in arrears. In April 2022, the fund earned dividends amounting to rupees 2 lakhs and it distributed 80% of the realized earnings. On 30th April, that is 30/4/2022, the market value of the portfolio was rupees 198 lakhs. Mr. Akash, an investor, subscribed to 100 units on 1/4/2022 and disposed of the same at closing NAV on 30/4/2022. What is his annual rate of earnings? So basically the later part of the question is focusing on determining the rate of return for a particular investor, but the remaining part of the question, the initial part, is completely talking about the scenario from the viewpoint of the mutual fund company, that is ABC Mutual Fund in this case. So can you notice one thing? This was the date on which the new fund was offered, 20 lakh units at rupees 10 per unit. So the gross proceeds that will be collected by the mutual fund will be 200 lakhs, out of which the fund has spent rupees 12 lakhs towards initial expenses. So cash balance remaining with the fund will be 188 lakhs. Out of that, they have created a portfolio costing rupees 185 lakhs. Balance amount will be lying in cash. Then some investments which were costing rupees 60 lakhs were sold for 63 lakhs and new investments were made at 56 lakhs. So with this, you have to keep track of two things: the value of investments at its cost and the market value, and the cash balance that is there with the mutual fund. Because what will happen, in order to compute the net asset value, you need to know the total assets in the hands of the fund and the outstandings and other liabilities related to that fund, so that you arrive at the net asset value. once you get the NAV as on 30th April 2022, after considering all this, then we will pinpoint the case of this particular investor and determine the annual rate of earnings for this investor. So let me help you in showing how to present the solution for this type of question. What you first do is, you start with the NFO issue, that is 200 lakhs, where 20 lakhs units were issued at face value of rupees 10 per unit, giving you the gross proceeds of 200 lakhs. Now this is not from the viewpoint of the investor, this is from the viewpoint of the mutual fund. From this you subtract the initial expenses, and the net amount that is in the hands of the mutual fund will be 188 lakhs. Part of this was invested and part of that was lying as cash balance. So the amount invested was 185 lakhs and the cash balance remaining was 3 lakhs. Now out of this 185 lakhs of investment, 60 lakhs which was cost of investment was sold, but it was sold for 63 lakhs, which will result into a capital gain of 3 lakhs. So keep in mind one thing, I am subtracting from the cost of the investment and I am adding to the cash balance. However, the amount subtracted from the cost is 60 lakhs, amount added in your cash balance is the sale proceeds, which will eventually give you a gain of 3 lakhs. Then what has happened? Again, new investments were made costing rupees 56 lakhs. So 56 lakhs will be added to the investment and will be subtracted from the cash balance. So final cost of investment by end of the month would be 181 lakhs and the cash balance will be 10 lakhs, correct? 3 plus 63 minus 56 will give you cash balance of 10 lakhs. The question is further informed that the fund expenses were 8 lakhs, of which 10% were in arrears. So out of 8 lakhs of expenses, 90% must have been paid. 90% of 8 lakhs will be 7.2 lakhs which will be paid, and 10% will remain outstanding. So outstanding will become a liability in relation to that fund by end of the year, and then the fund has collected some incomes in the form of dividends and interest on all the investments made, and that income was 2 lakhs. Now this is income. So logically, if you observe, your cash balance at the end before any other adjustment will be 10 lakh minus 7.2 lakhs plus 2 lakhs, which comes to 4.8 lakhs, and from this you are supposed to make distributions. Now distributions will be made to certain extent, that will be 80% of the realized income has been distributed. What would be 80% of the realized income? So this realized gain is basically part of your returns. This income is also part of your returns. In total, this amount is 5 lakhs. 80% of that will be distributed to the unit holders. So 80% of this gain of 3 lakhs would come to 2.4 lakhs and 80% of this income will be 1.6 lakhs. So both of these are distribution. If you remember, when we talk about the individual investor, we call distribution of gain as G1 and distribution of income as I1. So both of these are distributions, and from 4.8 lakhs, if you subtract this much cash balance, what remains at the end is 0.8 lakhs. So this is basically tracking of all your investments and cash balances. Once you write it up, we will then formally present the solution. But this is a good exercise in a question like this. Most important thing will be, you should keep track of how the funds are flowing from cash to investment and from investment to cash, how expenses are incurred, how incomes are received, how distribution is happening. If you can keep track of each and every transaction, this becomes a blueprint based on which you will be able to solve your question easily. So please write up this whole thing as part of your workings, and then I take you ahead. Alright friends, once you have completed writing this working, let us move ahead and start presenting the solution, but yet in the form of some proper presented working notes. So cash and bank balance working, basically this is just a summarized way of presenting your cash and bank balance working. So when you issued the NFO, you have obtained 200 lakhs. From that you subtract expense, you subtract the investment, you add the sale of investment, you subtract the new investment made during the month, then you subtract the expenses paid, you add the dividend received, and you subtract the distribution made on account of gains as well as distribution made on account of income, and final cash balance will be 0.8 lakhs. This rough working was made in the earlier type of working anyway, but that is basically for your understanding. In examination, I would prefer that you just go with the flow of calculations as presented over here. So please write up this whole working and then I take you ahead. Alright friends, once you have completed the working about cash balance as on 30th April 2022, next thing what you have to do is to compute NAV as on that date. To do that calculation, first identify that there are some outstanding expenses which will be 10% of total expenses, that is 10% of 8 lakhs, which is 80,000, and then you can work out the NAV as on that date, that is NAV as on 30th April 2022. How will you make this calculation? You first take the value of your investment portfolio, that is 198 lakhs. To this you add your cash and bank balance, that is 0.8 lakhs, and subtract the outstanding expenses, which is also 0.8 lakhs, and what you get is the net asset value in terms of the total value, that is 198 lakhs, and the per unit NAV can be determined by dividing this total NAV by the number of units, and that comes to rupees 9.9 per unit. So please write up this working as well and then I take you ahead. Alright friends, once you have completed writing this entire working, now we can move ahead and work out the rate of return for the investor, and to do this it's a simple task now. When you have to compute the rate of return for the investor, first you compute the holding period return, that will be HPR, and you know how to do that calculation. You know what are these variables. NAV1 and NAV0 are the NAV prevailing on the two respective dates. So we have the information about both of these NAVs. NAV as on 1st April was the issue price, that was the face value of the unit, that was rupees 10, and NAV as on 30th April 2022, we have already shown the working earlier. And now computing I1 and G1. So distribution on account of income, the total amount was known, the per unit amount has been extracted as 0.08. Likewise G1 has been calculated in terms of per unit as 0.12. When you substitute these values in the HPR formula, you will be getting the HPR, and then you can convert that into annualized returns. But first you write up this entire thing quickly. Alright friends, now after defining all these variables, time for us to substitute all these values in the HPR formula, and through this when you compute the holding period return, it comes to 1% for the month of April. You want to find it as annualized return, so what will be the proportionate return for 12 months? Simply 1% for 1 month, so it will be 12% for 12 months. So your final answer as annualized return for the investor, it will be 12% per annum. So please write up this calculation as well, and that will be end of the solution. Alright friends, once you have completed writing this solution, let us move ahead and take up the next question, that will be question 5b. Now this is picked up from the topic security analysis, and as per your textbook it is question number 2. Let us deal with this. The closing value of Sensex for the month of October 2007 is given below. They have given date and Sensex value for each day, and it is asked that you are required to test the weak form of efficient market hypothesis by applying the run test at 5% and 10% level of significance. Following value can be used. They have given you value of T at 5% is 2.101 at 18 degrees of freedom, and value of T at 10% is 1.734 at 18 degrees of freedom. And friends, similar values have also been given with 20 degrees of freedom. First of all, when you are applying T test, you are definitely not supposed to consider 20 degrees of freedom. Why? Because you need to consider the degrees of freedom as n1 plus n2 minus 1. So friends, n1 plus n2 minus 1 in this case is definitely not going to be 20 degrees of freedom. It will be 18 degrees of freedom, and how it will work I'll show you once the calculation of n1 and n2 is done. So keep in mind one thing, that 20 degrees of freedom won't be applicable. The simplest way how I could identify this, if I take you back to the question, can you notice the total number of days informed? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 and another 10. In total there are 20 days. So number of plus and minus signs definitely will not be 20. It will be 1 less than 20, that will be 19. The reason is n1 and n2 will depend upon the previous day calculation. We don't have any information about the index value of the day prior to 1st October 2007. As a result, the change in value can be observed only from the next day. Finally, if there are 20 days in calculation, the total number of positive and negative signs will be 19, and from that 19, which can be considered as aggregate of n1 and n2, when you subtract 1, you will get what? You will get 18 as the value. As a result, you are not supposed to consider 20 degrees of freedom, you will consider 18 degrees of freedom. So the last two lines of that information is basically given for you to get confused. If you are clear with your concepts, you will not get confused. Now let us see how to present the solution. In the solution, you will first plot this table and you work out one simple thing, that is a sign of change which will be observed based on the previous day's index value. For the first day we have no clue, just leave it blank. For the second day, observe one thing, 2800 2780, the index value has declined, so put a minus sign. Then the index value is 2795, it has increased, put a plus sign. Further increased, put a plus sign. Then again it has declined, right? So minus sign. Again increased, plus 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 sign. Over here again it has increased as compared to the previous day, so again a plus sign. 3450, another increase, another plus sign. 3360, decline, put a minus sign. 3290, further decline, again a minus sign. 3360, it is increasing, plus sign. 3340, minus sign. 3290, further declined, minus sign. 3240, further decline, minus sign. 3140, further decline, minus sign, and 3260 is the increased value, so it will be having a plus sign. So friends, do one thing, before I take you ahead, please note down this as part of your solution. Alright friends, you would have finished writing this whole thing. Now through this working, mainly what we have to do is find out two things. One is count of R, then count of N1 and N2. So let us first count R. R stands for number of runs. So if you observe, from here the sign begins, right? So it is first sign, it is a negative sign, will be counted as 1 R. Then the sign changes, right? The next run begins from here, positive, positive, counted as number 2. Again negative, counted as 3, then positive, 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 up to here, counted as 4, then minus, minus, counted as 5, then again plus, counted as 6, minus, 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 all counted as 7, and then this is 8. 8 times signs are changing. In other words, the signs are found to change overall 8 times. We will call this as 8 times as number of runs. Secondly, let us count the value of N1 and N2. N1 and N2 will be the number of plus signs and minus signs. So let us first count the plus signs. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 and 11. And let us now count the minus signs. 1, 2, then 3, 4, 5, 6, 7 and 8. So N1 will be 11 and N2 will be 8. So let us now proceed ahead and plot those N1 and N2 values along with the number of runs, and we will be ready to compute the average, which is symbolized as mu. So R, that represents total number of runs. So you can see the first run contains just one minus sign, second run consists of two plus signs, third run a single minus sign again, fourth run so many plus signs, then fifth run minus signs, sixth run just one plus sign, seventh run minus signs and eighth run one plus sign. In total we have found that 8 times the signs are changing. We will call this as total number of runs are 8 runs. So R equals to 8. Thereafter the number of positive changes or the positive signs, N1 equals to 11, we have already counted, and N2, which indicates the negative values, it will be 8. N2 will be 8. Once you get N1 and N2, you are ready to compute mu. Mu will be 2 times N1 into N2 divided by N1 plus N2 and finally plus 1. So when you apply this calculation, it is 2 into 11 into 8 divided by 11 plus 8 and then added 1. Finally, when you make this calculation, 2 into 11 into 8 gives you 176 divided by 11 plus 8 will be 19 and plus 1. So 176 by 19 plus 1 will finally give you 10.26. So we can conclude mu equals to 10.26. So friends, note down all these calculations and then we shall move ahead. Alright friends, let us move ahead, and the next step will be to compute the deviation. So deviation will be computed by using that formula 2 times N1 into N2 into again 2 times N1 into N2 minus N1 minus N2 whole upon N1 plus N2 whole square into N1 plus N2 minus 1, and the whole value will be taken as a square root at the end. So we put up these values, and once you put up all these values, you can easily make out the calculation. So it will be square root of 176 into 157 divided by 19 square into 18, and what you get finally is square root of 4.252, and that will be 2.06. So friends, note down this as well, and then we shall move ahead. Alright friends, let us now move ahead and apply the test. So we would say test at 5% level of significance at 18 degrees of freedom using T table. Now you definitely understand why we are taking 18 degrees of freedom, because these 18 degrees of freedom will indicate N1 plus N2 minus 1, and N1 plus N2 11 plus 8 minus 1 will definitely give you 18. And now using T table, the lower limit can be computed as mu minus T value into sigma. So mu is 10.26, T value is given as 2.101 and sigma we have computed as 2.06. When you make this calculation, you get 5.932 as lower limit, and for computing the upper limit, this T into sigma will simply be added. So the upper limit will be mu plus T into sigma, and that will be 2.101 into 2.06 added to the average, that is added to mu, and what you get is 14.588. Now check one thing, the number of runs were 8, which is falling between these two, correct? So but that conclusion will be writing at the end, because after 5% level of significance we have to even check at 10% level of significance. So do one thing, write up this much first. Alright friends, let us move ahead and now make similar calculation with 10% level of significance. Now I don't have to explain it again. Lower limit will be computed in the same way, but now can you see mu and sigma remain same, only the t value, the table value of t is different now, and we get lower limit as 6.688 and now upper limit as 13.832. We still find that the number of runs being 8 are lying between these lower and upper limit. Let us conclude that we can say as seen R lies between these limits, hence the market exhibits weak form of efficiency. So we can say because R is lying between the upper and lower limit, your assumption that markets are weak is holding good, and finally concluded that the market is exhibiting the weak form of efficiency. So note down this whole thing, and that will be end of the solution. Alright friends, once you have completed writing this solution, let us move ahead and take up the next and last question, that will be question 5C. Now this is again picked up from the topic International Financial Management, and in your textbook it will be question number 14. So let us deal with this. Odisha Limited has proposed to expand its operations, for which it requires funds of $15 million net of issue expenses, which amount to 2% of the issue size. It proposed to raise the funds through a GDR issue. It considers the following factors in pricing the issue. Number 1, the expected domestic market price of the share is rupees 300. 3 shares underlie each GDR. Underlying shares are priced at 10% discount to the market price. And lastly, given expected exchange rate is rupees 60 per dollar. You are required to compute the number of GDRs to be issued and cost of GDR to Odisha Limited if 20% dividend is expected to be paid with a growth rate of 20%. So let us figure out how to write up the solution for this question. In the solution, you should first begin with the fact that the net issue size, what you want after all issue expenses, is 15 million in terms of US dollars, and you know one thing, that 2% will be the initial expenses. So US dollar 15 million should be the net proceeds in hand after 2% expenses. So the gross issue has to be $15 million divided by 98% or divided by 0.98. That will give you $15.306 million. Issue price per GDR in rupee will be rupees 300 multiplied by 3, that is 3 shares underlying each GDR, and multiplied by 90% because the issue will be discounted at 10%. So this comes to 810 in terms of Indian rupee. So issue price per GDR in dollars will be 810 divided by 60, that will be $13.5, and net proceeds per GDR will be rupees 810 into 0.98, that comes to rupees 793.80. So number of GDR to be issued will be $15.306 million divided by $13.5 per GDR, and that comes to 1.1338 million in terms of number of GDRs. So please write up this calculation and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and continue writing the solution further. Cost of GDR to Odisha Limited. You know what you have to do is to find the cost of equity, that is KE, and KE equals to D1 by P0 plus G. You know how to define these variables. D1 is the expected dividend per GDR by year end. So rupees 2 is basically the dividend per share, and because there are 3 shares underlying each GDR, the dividend per GDR will be rupees 6. The KE as a symbol indicates the cost of GDR to the company. P0 is the net proceeds per GDR. Now here we have to understand that the calculations are made in Indian rupee value only. So the proceeds per GDR in terms of Indian rupee is rupees 793.80 and growth rate is given as 20%. That stands for G, and when you apply these calculations, what you get is 20.76% as the cost of equity, or you can call it as cost of GDR to the company. If you are wondering why we have written this note over here in reference to this dividend per share, look at one fact. The question did not specify the face value of the share. They have only mentioned the dividend rate as 20%, and we have considered rupees 2 as dividend per share in Indian rupee value. So basically we are taking an assumption that the face value of the share will be rupees 10, and based on that assumption D1 has been computed as 20% of 10, that is rupees 2. So when question is having this missing information, don't miss out on putting forward this kind of assumption. So please write up this whole thing, and that will be end of the solution.